You pull out your phone, you tap a screen, you scan your face, and poof, thousands of euros are instantly transferred across the world.
Yeah, it feels entirely frictionless. I mean, it basically feels like magic.
Right, exactly. But, whenever we look at European financial regulation, that feeling of magic usually evaporates pretty quickly.
Yeah. Usually replaced by the expectation of just really dry, bureaucratic red tape.
Exactly. But today, though, we're looking at a stack of legal analyses, industry white papers, and regulatory compromise texts that actually tell a very different story.
Because that dense regulation, it's the invisible machinery that actually protects your money.
Yeah, it dictates quite literally every single click, swipe, and notification in your banking app.
It really is the engine under the hood. We generally ignore it as long as the car is running, but right now, the entire European banking sector is pulling into the garage for, a massive overhaul.
Which brings us to, I think, the perfect analogy for what we're unpacking in this deep dive today.
Yeah.
I want you to imagine your bank is a smartphone. For years now, it's been running on this reliable but, aging operating system based on the 2009 Payment Services Law.
Right. It's done its job, but the digital world has obviously moved on.
It really has. So now, this massive system-altering two-part software update is rolling out. Those updates are called PSD3 and the PSR.
And our mission today is to figure out what happens when the industry actually hits install.
Yeah. We're going to unpack how this new regulatory package will specifically impact private banking in Luxembourg.
And to really understand the scope of this, we first need to look at the timeline. As of today, June 22, 2026, the EU package for these new rules is sitting in its final compromise text form.
Okay, meaning what exactly?
Meaning the political architects have essentially agreed on the blueprints, but the final binding laws haven't taken effect just yet.
Got it. So the update is downloaded to the device, just waiting for that final prompt to restart. But, going through the source material, I noticed a really strange discrepancy. If you look at the industry headlines, every fintech conference and banking seminar is just obsessing over PSD3, the third Payment Services Directive.
Oh, absolutely. It's the big buzzword.
Right. Yet the legal white papers we're looking at are flashing this giant neon sign basically saying, hey, look over here at the PSR instead.
Yeah, they are.
So why is the industry hyper-focused on PSD3 when the real operational impact seems to live inside the PSR?
Well, it comes down to the fundamental mechanical difference between what these two texts actually do, both in scope and in legal authority.
Okay, let's break that down. Scope first.
Yeah, let's look at the scope. PSD3, the directive, is primarily focused on the behind-the-scenes institutional mechanics.
Like what?
Things like authorization processes for becoming a payment institution, the supervision of e-money institutions, and what are known as prudential rules.
Let me jump in there just for the non-lawyers listening. Prudential rules. Does that basically just mean the financial cushion a bank is legally required to keep in the vault so they don't go bust if the market tanks?
That is a big part of it, yes. It's the framework ensuring the institution is structurally sound, adequately capitalized, and governed correctly.
So the regulators just want to know the house isn't built on sand.
Exactly.
So if I'm a private banking customer, PSD3 is happening entirely behind a closed door. I mean, it's just the bank talking to the regulator. I'm never going to see it.
Right, you won't see PSD3. But the PSR, the Payment Services Regulation, is a completely different beast.
Oh, so?
The sources point out that the PSR carries the rules for conduct, transparency, fraud prevention, and account access.
Oh, wow.
Yeah, so user information, fee transparency, your specific rights and obligations as a client, all of those customer-facing elements are moving into the PSR.
Okay, so if PSD3 is the building code determining how the bank is structurally built and zoned, the PSR is the interior design, the locks on the doors, the layout of the lobby.
Yeah, exactly.
And the customer service manual that every teller has to memorize.
That's a great way to put it. And beyond the scope, there's a critical legal mechanism driving this shift. Notice the letters. PSD3 is a directive. PSR is a regulation.
Which means?
Under European law, a directive gives member states a goal, but requires them to transpose it into their own national laws. So Luxembourg might implement it slightly differently than France or Germany.
Ah, so it leaves some wiggle room.
Right. A regulation, however, has direct application. It applies automatically, uniformly, and immediately across the entire European Union the day it takes effect.
Wait, so it bypasses the national legislatures entirely?
Exactly. Because these highly visible user-facing rules are being packaged into a regulation, they represent immediate, unignorable operational changes.
Because a bank can't wait to see how the Luxembourg Parliament interprets the text. The European text is the final word.
Yep, they just have to comply.
Okay, so we have this new inescapable customer service manual and these new locks on the doors via the PSR. Let's talk about how that actually ripples through the day-to-day reality of a private bank.
Because it's a huge shift.
Yeah, reading through the white papers, this is clearly not just a lawyer sitting in a back room checking a compliance box.
No, not at all.
The sources actually break the impact down into 4 distinct pillars, right? Documentary, digital, operational, and organizational.
Yeah, this is really where the theory hits the road. The documentary pillar alone is just staggering.
How so?
Well, a bank has to heavily scrutinize its general terms and conditions for all accounts and payment services. The new PSR requirements dictate precisely how pre-contractual info is presented,
Right.
how fee structures are outlined, what execution times are promised, and exactly what user rights are guaranteed.
I imagine this just means rewriting the endless reams of paper we all sign but never actually read. But how does that mechanically change things?
What do you mean?
Like, is it just changing the font size? Or are they fundamentally altering the promises they make to the client?
Well, it's definitely the latter. If the PSR states that a client has a specific right to reimbursement under a certain type of delayed payment, that exact mechanism has to be legally codified in the bank's documents.
Wow.
Yeah. If the bank's legacy contract gives them, say, 5 days to investigate a claim, but the new PSR says they only have 3.
Then every single client contract containing that clause is suddenly out of compliance.
Exactly. And it exposes the bank to regulatory action.
Which naturally bleeds into the digital pillar, I'm assuming.
Right.
Because my relationship with my bank is almost entirely through the screen on my phone.
Right.
So the digital interface has to reflect all these new documentary promises, too.
Oh, absolutely. The digital interfaces in banking applications will require significant overhauls. First, they have to solve this huge UI/UX challenge.
Displaying all the new info.
Yeah, displaying all this required transparency regarding fees and execution times, but without cluttering the screen and ruining the user experience.
Right. Nobody wants an app that reads like a legal textbook.
Exactly. But the much heavier lift involves integrating entirely new mandatory fraud prevention controls directly into the client's digital journey.
Okay, so if I'm a client logging into my private bank account on day 1 of this new regime, what's the first thing I'll notice? I'm guessing I'm going to experience a lot more friction.
Yes.
And I mean friction in the sense that the app is going to be a lot more interrogative before it actually lets me move my money.
You are definitely going to see visible fraud checks. When you add a new beneficiary or initiate a large transfer, the interface will prompt you with warnings.
Okay.
Or it'll require secondary confirmations that just weren't there before.
Yeah.
The system is mechanically designed to slow you down just enough to ensure you aren't being spoofed or manipulated by a bad actor.
Makes sense. Okay, so that covers the documents and the app. What about the operational and organizational pillars? Because someone has to manage all this new caution behind the scenes, right?
Definitely. The operational teams have to completely review their internal procedures for payment processing. Like, how does a wire transfer move from initiation to settlement under the new rules?
Right.
They also have to overhaul how they handle complaints and security incidents. If there's a suspected fraud attempt, the internal protocol for freezing the account, investigating the breach, and reporting it to the authorities, all of that has to meet strict new timelines set by the PSR.
Wow. And the organizational pillar, what does that involve?
This centers heavily around something called open banking.
Oh, I've heard of that.
Yeah, so the PSR dictates how third-party providers can access a client's account information, with the client's permission, of course. The legal and compliance teams have to reorganize their data sharing structures to grant that access safely.
Okay, wait, I need an Eli 5 on this. Are we talking about when I connect, like, a budgeting app on my phone to my main bank account so it can track my spending?
That is a perfect example. Under open banking, the bank cannot hoard your data.
Oh, interesting.
If you tell the bank to share your transaction history with a third-party budgeting app, the bank is legally required to facilitate that.
Right.
They do this by building APIs, application programming interfaces, which act as secure bridges between the bank's internal servers and the outside app.
I gotta say, if I'm the chief information security officer at a private bank, that sounds like a literal nightmare.
That's a huge headache.
You're telling me I have to spend millions of euros building this massive digital fortress to comply with the new fraud rules, but then the organizational pillar forces me to install a specialized doggy doors so third-party apps can get inside.
Yes, and that tension is exactly why the organizational shift is so profound. The bank has to facilitate data sharing while still bearing the ultimate responsibility for keeping the vault secure. It requires a complete restructuring of risk management.
Okay, so looking at this mountain of changes, rewriting contracts, redesigning apps, rewiring internal payment processes, and building secure APIs, you clearly cannot just flip a switch overnight.
No, definitely not.
How does a bank actually begin to tackle this without completely breaking their current operations?
Well, the sources outline a very pragmatic action plan, broken down into what they call the 3 checks.
Okay. If I'm a CEO, my first instinct is to just start rewriting software code immediately.
Right.
But I imagine you can't build a new system if you don't even know how your old one maps to the 2009 laws. Is that where this starts?
You nailed it. Check 1 is indeed mapping. A bank has to comprehensively map the payment services they actively provide right now.
Like what?
Cash accounts, card services, wire transfers, digital journeys. They have to match every single one of those pathways against their current obligations under the baseline 2009 law.
I mean, getting a map of how money moves through a bank sounds like it should be easy. Don't they already know how their own systems work?
You would really think so. But in large, older private banks, finding that map is honestly like doing digital archaeology.
Digital archaeology?
Yeah. Many legacy core banking systems are built on mainframe architecture from the 80s and 90s, with layers upon layers of modern API overlays just stacked on top over the years. Getting a clean, comprehensive inventory of every payment journey is an incredibly heavy lift.
Yeah.
But you have to establish your baseline.
Right. You got to know where you are. So once they finally dig up that map and know where they stand, where do they go next?
They move to check 2, which is isolating the likely fraud control changes. The PSD3 and PSR package severely strengthens prevention mechanisms, and the sources highlight several massive shifts here.
Okay, what's the first one?
First, there will be mandatory fraud-related information sharing between different payment providers.
Interesting.
Second, there are new rules specifically targeting spoofing.
Let's pause on spoofing for a second. When most people hear fraud, they usually think of someone stealing their password. But spoofing is a different mechanism entirely, right?
Yeah, it is.
How does a fraudster actually spoof a bank in a way that requires new regulatory intervention?
So, spoofing relies on impersonation, usually through manipulating caller ID or SMS systems. A bad actor can make a text message appear on your phone, right inside the legitimate thread of messages you usually get from your bank.
That is terrifying.
It really is. They say, "We detected suspicious activity. Click here to verify your login." Or they call you, and your phone displays the actual phone number of your local bank branch.
So it looks completely real.
Exactly. The PSR forces banks to implement dynamic linking and much stronger customer authentication mechanisms to break that illusion mechanically.
It sounds like the regulation is shifting its focus from just protecting the bank's servers to actually protecting the psychological vulnerabilities of the end user.
That's a great observation.
Yeah.
Which leads directly to the third major shift in Check 2. Adjustments to liability and reimbursement rules.
Oh.
The PSR mechanically shifts the financial burden of fraud. Historically, if you fell for a scam, the bank could argue you were negligent and just refuse to reimburse you.
Right, the it's your fault defense.
Exactly. The new rules flip the burden of proof. The bank is essentially presumed liable for certain types of spoofing unless they can definitively prove gross negligence on the part of the client.
Wait, wow. Shifting the burden of proof is huge. That completely explains why the app is going to be so much more interrogative. The bank's own money is on the line now.
Yes, precisely.
What else is in Check 2?
The final, and perhaps most operationally complex piece of Check 2, is a strict consistency check required between the beneficiary's name and their IBAN.
I have to be honest here. A consistency check between a name and an account number, just making sure that if I type in the IBAN for John Smith, the account actually belongs to John Smith, sounds incredibly basic to the average person.
It does.
Why is implementing this treated as a major operational hurdle that requires overhauling internal controls?
It seems like a simple visual check to you and me. But remember those legacy banking systems we talked about?
Right, the 80s mainframes.
Yeah. They were built decades ago to process strings of numbers, not text. For years, the routing system only cared if the IBAN was a valid, mathematically sound account number. It didn't cross-reference the text field of the name, because text is messy.
Ah, the computer only cares about the math.
Right. What if the account is officially registered under Jonathan Smith, but you type John Smith? What if it's J. Smith?
Yeah.
What if there's a typo, like John Smith?
Or what if it's a corporate entity doing business under a different trade name?
Exactly.
Oh, I see the problem. If the new regulation says you must ensure the name and the IBAN match before executing the payment, the bank's old numerical routing system suddenly has to become this sophisticated, text-analyzing, fuzzy logic engine.
Yes. The bank has to build an entirely new internal control system to execute that consistency check in milliseconds.
Wow.
And it's a delicate balance. If their logic is too strict, they delay millions of legitimate transactions because someone missed a middle initial angering clients.
But if the logic is too loose,
They fail the regulatory check and swallow the liability for fraud. It fundamentally changes the payment validation journey.
Okay, so check 1, map the current services via digital archaeology. Check 2, isolate these huge fraud control changes, like spoofing liability and the nightmare of name IBAN matching. Logic would tell me that check 3 is where the legal team fires up the word processors and starts rewriting all those client contracts.
Well, logic would lead you astray.
Really?
Yeah, here's where the sources offer a very surprising piece of strategic advice. Check 3 is indeed about preparing for changes to fees, exchange rates, merchant name visibility, and open banking access. But there is a massive strategic pause you have to take.
Which is?
Do not draft definitive new contractual clauses right now.
But wait, we just spent this whole time establishing that the terms and conditions have to perfectly reflect the new rules. The banks have all this liability hanging over their heads. Why wouldn't they want to get a head start and write the new contracts immediately?
Because of the timeline we established at the very beginning. As of June 22, 2026, the European texts are only in their final compromise text form. They haven't been finally adopted by the Parliament.
Ah, they're aiming at a moving target.
Exactly. If you pay an external legal counsel thousands of euros an hour to draft definitive binding contractual clauses today, and the final adopted text tweaks a single liability rule by even one sentence.
You have to throw all that expensive work in the trash.
Yes. It is incredibly costly and inefficient.
But a compliance officer can't just sit on their hands and wait for the final law to drop, right? If they do nothing, they'll be scrambling and out of compliance the day the regulation takes effect.
Right.
So what is the actual mechanism for preparing without overcommitting?
The sources recommend a very specific auditing tool, the gap register.
The gap register.
Yeah. Instead of writing new contracts, the bank prepares a comprehensive internal document. This register identifies the exact mechanical differences, the gaps between three things.
Okay, what are the 3 things?
The current requirements under the 2009 baseline, the contracts the bank currently has in circulation exactly as written, and the changes that are likely to result from the future PSD3 and PSR package.
Oh, I get it. So creating a gap register is basically measuring all the windows in your house for new curtains and writing all those dimensions down in a notebook.
Right.
But you hold off on actually taking the scissors to the expensive fabric until you're absolutely sure the house is finished settling and the frames aren't going to shift.
That's a perfect analogy. You do all the prep work. You identify every single clause that will need to change. But you wait to draft the final legal text until the rules are officially locked in.
That makes total sense.
This gap register strategy allows the bank to achieve agile compliance, identifying every necessary adaptation well before the new rules apply, without wasting resources on premature drafting.
Well, let's synthesize this, because we have covered a massive amount of ground today. We started by realizing that moving from the old 2009 payment services law to the new PSD3 and PSR package isn't just some dry institutional update. It is a sweeping operational overhaul for private banking in Luxembourg.
It alters the mechanics of how the entire institution functions, top to bottom.
And the big takeaway is that while everyone uses the buzzword PSD3, it's actually the PSR, the regulation with direct, immediate application that forces the real changes.
Exactly.
The PSR shifts the liability of fraud, enforces new transparency, and forces banks to update documents, redesign digital apps, and totally rewire their payment processing. And they manage this by mapping legacy systems, isolating fraud controls like that complex IBAN text matching engine, and using a gap register to prep for contract changes without jumping the gun.
And that leads to a lingering tension that the entire banking industry is going to have to grapple with over the next few years.
Oh, what is the ultimate friction point?
Well, we talked about the organizational pillar, right? Where the PSR forces banks to open up client account access to third-party providers via APIs.
The doggy doors.
The doggy doors. They are legally required to put more doors into the vault. But at the exact same time, through the fraud control pillar, the PSR is tightening the bank's liability for spoofing and unauthorized access, shifting the financial burden onto the institution.
Wait, so they're being forced to open the doors wider while simultaneously raising the stakes for letting the wrong person in?
Yes.
So as the ecosystem becomes more porous, but the financial penalties become more strict, where will the ultimate responsibility for a client's data security actually fall when a breach eventually happens? Who pays the bill when a third-party app gets compromised, but the bank holds the liability?
That is the multi-million euro question that the regulators haven't fully answered yet.
Man, that is a tightrope walk right there, and definitely something we'll have to watch as these compromised texts become final law. Thank you for joining us on this deep dive. Keep an eye on your banking apps, pay attention to those terms and conditions, and as always, keep questioning the invisible systems that run your world. We'll catch you next time.